The market swept the liquidity from a major level. I took an entry, and the market came back and hit my stop loss. Does this often happen with you? You take an entry with a liquidity sweep at a major level, which looks like a valid entry. But even after that, the market hits your stop loss. Why and when does this happen? In today's video, we'll understand this in detail. This video will explain all the concepts of liquidity well, from basics to advanced. If you don't know about liquidity, what liquidity actually is, what its function is, and where it occurs, all of this will become clear to you. The topics of this video are: first, liquidity. Second, liquidity sweep. Third, what is a valid liquidity sweep? Fourth, how to consider a valid liquidity sweep for trading. Fifth, mistakes that retail traders make. Sixth, examples of valid liquidity sweeps across different timeframes. Seventh, how we use liquidity in the ConfluenceFX method. Okay, so first, let's understand liquidity. What is liquidity? The pool of pending orders, sitting at a price level, waiting to be filled. Let's break it down. Every trader in the world who is trading is doing so by looking at the chart. Where to buy, where to sell, everything happens on the basis of the chart. Now, when something appears on the chart, a large number of traders feel that the market will go up from here, or go down from here. Let's understand this with an example. This is a level from where the market went down last time. Seeing this, many people place their sell orders at this level. The idea is, when the market comes back here, it will go back down again. Now, this level where pending orders have built up is called a liquidity pool or pending order zone. This is what happens when the market hits a level 2 or more times. A pool forms around that zone where retail traders' pending orders accumulate. This is one type of liquidity. The second type of liquidity, which is the opposite of the first type of liquidity, is one in which operators target pending stop losses instead of pending orders. Example, from a level, a point, the market went down. Now, in this downward move, the traders who made an entry will obviously place their stop loss at that candle's high. Because of this, at that level, at that zone, many stop loss pending orders accumulate together. Similarly, when the market goes down from a level 2 or more times, the traders who entered during those moves will have their stop losses above, in this zone. This is called a stop loss pending order level, or stop loss pending zone. So far, we've seen what liquidity is, and what types of liquidity there are. Now, let's understand how operators use this. Institutions or large players need to place orders in a large quantity. They cannot place all their orders together in one place without moving the market in the opposite direction to their own. Operators need their opposite side. That is, liquidity pools of new pending orders or stop loss pending orders in bulk quantity, which operators use to fill their large orders. Liquidity sweep. A liquidity sweep happens when price deliberately pushes just beyond a recent high or low, triggering all the stop loss orders sitting there, and then reverses, moving in the opposite direction. Visually, it looks like this: a candle with a wick beyond the previous high or low. The candle's body closes back inside the previous candle's range. It doesn't sustain the breakout. This is often followed by a strong reversal in the next 1-2 candles. Let's understand liquidity sweep psychologically. This is the previous high on the daily timeframe chart, then the market goes down. The retail traders who entered on this move have their stop loss at the previous high, and new retail traders also place their orders with a stop loss at that previous high. This is very predictable. Price just pushes past that level, enough to trigger those stop orders. Those triggered stop losses provide operators the volume, or liquidity, needed to enter a position in the opposite direction. Therefore, after hitting the stop losses, price reverses sharply, as it has completed its work of grabbing the liquidity. So, till here, we've learned what liquidity and liquidity sweep are, both visually and psychologically. Now let's understand a valid liquidity sweep, which decides the direction of the trend. The market moves on the basis of liquidity sweeps only. So we have to understand which liquidity sweep is valid and which is invalid. If the liquidity sweep is valid, the market will go in that direction. If the liquidity sweep is invalid, the market will definitely return to take liquidity from that point. Let's understand a valid liquidity sweep first. A valid liquidity sweep is when price sweeps previous major level and also sweeps the previous candle of the current timeframe same time. In simple words, a valid liquidity sweep is one which sweeps the major level's liquidity. At the same time, it should also sweep the liquidity of its previous candle on the current timeframe. To understand this better, consider this example. Here is a zone of the previous low of a weekly candle. To sweep the liquidity of this weekly candle, price must go beyond this weekly candle's low level and return to the price range. Now, to understand whether this liquidity sweep is valid or not, we have to move to the daily timeframe chart. On the daily timeframe, the first candle, which sweeps the liquidity of the weekly candle's range low, must also sweep the liquidity of the previous candle on the daily timeframe. This means price must sweep the liquidity of the previous daily timeframe candle, along with the previous weekly low. So, this is a valid liquidity sweep. Now, what happens if it's not like this? The market sweeps the liquidity of its previous major level, but doesn't sweep the liquidity of its own previous candle on the current timeframe. Then this becomes an invalid liquidity sweep. Here we have an real BTC example of invalid weekly liquidity swipe of 20 July 2026. Here weekly zone is swipe, but the daily timeframe candle did neither swipe nor grab the liquidity of the candle which swipes the liquidity of weekly high. Now you can see the result clearly, market go upside. After it swiped the weekly liquidity for downside. So that's how weekly liquidity swipe works. This is where retail traders make a mistake. They don't know this rule of liquidity sweep, because of which they just consider a close inside the previous candle as a liquidity sweep. And this way, they become a victim of the operator's trap. Now let's look at some common mistakes that retail traders make. First mistake, when price goes above the previous candle's high and closes back within the range, just by seeing this, retail traders consider it a liquidity sweep. Second mistake, retail traders confirm a liquidity sweep using only a single time frame. Third mistake, retail traders don't know how to use a liquidity grab on the lower time frame to confirm a liquidity sweep on the higher time frame. Retail traders don't know how a lower time frame's liquidity sweep affects a higher time frame's liquidity sweep and decides the trend. Till now, we have understood a valid liquidity sweep and its visual examples, and some common mistakes retail traders make while analyzing the market. There are several other methods for how a valid liquidity sweep can look, which we'll discuss in the next videos, as adding them here would only confuse you. In the next videos, we'll learn when the daily timeframe candle closes beyond the weekly level. Second, when the daily timeframe candle sweeps the weekly level, but doesn't close below the previous daily timeframe candle. Third, when price closes above both the weekly high and the previous daily timeframe candle's high. Now let's move to some real chart examples to understand the liquidity swipe on different time frames. Here is our higher time frame, the weekly chart of 15th June 2026 here. First, we see that the market swept the liquidity of its previous candle. Let's check, is this liquidity sweep valid? For this, first, we mark its high and draw a level at 65,760. Now, to validate this sweep, let's shift to the daily timeframe chart. Look at this. This is the zone we marked on the weekly candle's high at 65,760. Now, on the daily timeframe, the very first candle, which is Monday's, that touched that zone, goes beyond the high and closes above it. Then the next candle, which is Tuesday's candle, Tuesday candle back inside and closes below 65,760, grabbing liquidity of previous weekly and daily high. So, according to the ConfluenceFX method, this weekly sweep passes the test, and it is a valid weekly sweep, which determines the major trend. Now, see the result. The market will remain in the same direction unless it sweeps liquidity from the opposite side. Let's see another example of a weekly sweep. But this time, we'll see a liquidity sweep of the weekly zone instead of the weekly candle. We found a weekly zone at the 65,500 level. We'll mark it as a zone. We wait for the market to come to this level. A weekly candle sweeps the liquidity of the zone. Now, we have to find whether this sweep is valid or not. So, to find this, we'll move to the daily timeframe chart. On the daily timeframe chart, see this, the very first candle of the 29th of March, that is Sunday's candle, sweeps the weekly zone. This candle also sweeps the liquidity of the previous candle on the daily timeframe. So, it passes the ConfluenceFX sweep method rule. Therefore, this is a valid liquidity sweep. See the result, the screen is in front of you. Now, we'll see some examples of a daily liquidity sweep, how daily liquidity sweep looks. Here is a liquidity sweep that happened on the daily timeframe chart on the 21st of May. First, we'll mark the high of the daily timeframe candle. This zone is at 77,767. To find whether this liquidity sweep is valid or not, we have to move to the hourly timeframe chart. Here, on the hourly timeframe chart, we can see the very first candle which touches the zone we marked on the high of the previous daily candle. That same candle goes beyond that zone and closes above it. Then the next hourly candle sweeps the liquidity of the previous candle, which we saw closed above the zone. So, this liquidity sweep passes the rule of the ConfluenceFX method, and this is a valid daily liquidity sweep. First, you must remember one thing. As we go to shorter timeframes, the market starts to sweep liquidity more times, like in this example. The market sweeps the liquidity on the hourly timeframe again. It means the market swept the daily timeframe zone to times on the hourly timeframe. If we go to even lower timeframes, the liquidity sweeps get more frequent, so the result is on screen now. As we did on weekly, let's now see an example of liquidity swipe on daily time frame. Instead of previous candle, we will analyze the liquidity swipe of zone on daily time frame chart. Here, we can clearly see market respected this level at 62 to 65. So we will mark it as a zone first, wait for the market to come to this level. Here on 13th July 2026 candle of daily time frame, swipe the liquidity of the zone. Now let's check the liquidity swipe is valid or not. For that, we will move to hourly time frame chart. Here on hourly time frame chart, the very first candle which swept the liquidity of the zone also gets swept by another hourly time frame candle. Therefore, the liquidity swipe is perfectly valid. Here, you can see market take the liquidity of daily time frame zone to times on hourly time frame. It swiped the daily time frame zone liquidity, then it swiped the liquidity of previous swipe candle. And then you can see the result in front of you. This is how the liquidity sweep works. Let's see one on an hourly time frame chart. This is the 17th of August 2026, Monday chart. Here, we found a liquidity sweep at the 3:30 AM candle. Let's find out, is this liquidity sweep valid or not? To know that, let's first mark the low of the previous 2:30 AM candle. We can clearly mark the zone at 60 to 1,707. Now to understand whether this liquidity sweep is valid or not, we have to move to a lower time frame. In this case, we'll move to the 5-minute time frame chart. Here, you can see the very first candle touches the marked zone, goes beyond it, and closes below the zone. Then the next candle returns to the zone and closes inside it. Here, as it grabbed the liquidity of the hourly candle, along with its previous 5-minute time frame candle, this should be considered a valid liquidity sweep, according to the ConfluenceFX method. Now, see the result. As we followed before, let's see another hourly time frame liquidity sweep example, but now with a liquidity sweep zone. We're on the hourly time frame chart of the 10th of August, 2026. Here, we have a strong rejection zone at a level of about 65,190. Let's mark it as a zone. As the ConfluenceFX rule says, to know if this liquidity sweep of the 6:30 AM candle is valid or not, we have to move to the 5-minute time frame chart. Look at this, the 7:20 AM candle. This candle grabbed the liquidity of the hourly zone, along with the previous 5-minute timeframe candle. Therefore, it is a valid liquidity sweep according to the ConfluenceFX method. Now, understand how we use liquidity sweep in the ConfluenceFX method. Our method is based on price action, liquidity sweep, and Fibonacci. First of all, we analyze the weekly time frame to find a valid liquidity sweep, which shows us the major time frame direction or trend. Then we shift to the daily time frame and look for a valid liquidity sweep in the same direction as the weekly. We draw Fibonacci levels on the liquidity sweep candle and mark the 0.618 to 0.786 levels. Next, we find entries for swing as well as intraday setups accordingly. That's everything on liquidity and liquidity sweep, from the basics to how we use it in the ConfluenceFX method. If this helped you understand the market better, subscribe. More breakdowns like this are coming every week. Want personalized analysis on your own charts? Links in the description for my Fiverr gig. You can also check our LinkedIn handle, ConfluenceFX, for our past analysis. See you in the next one. Disclaimer, this content is for educational and informational purposes only. It is not financial advice. Trading futures, options, and crypto involves substantial risk of loss and is not suitable for every investor. Past performance and chart analysis do not guarantee future results. Always do your own research and manage your own risk before making any trading decision.